Everyone, and thank you for joining us for our self-directed class here this lovely Tuesday afternoon. No matter where you're joining us from, we are glad to have you. We've got some really great education planned for today with Fuquan, but before I introduce him and bring him up, I'm going to run through a couple of brief announcements, share some upcoming events that we have, and some promotions as well. So without further ado, let's get going. So just like today, we have a lot of educational classes and webinars for you guys, and they are all free. So every Tuesday and Saturday at 12 p.m. Central Time, we host these online webinars. They're usually about an hour long. We bring in guest speakers, and we have Q&A sessions at the end so you can really get your questions answered and ask everything that you want to know. But they're also really good places to come and network in the chat box. If you're looking for maybe a little less education, more networking, we also have our virtual networking happy hour, which is on the fourth Wednesday of every month at 6:30. Now, this is a change. We did used to do it the first and third Wednesday, so do be aware that that has made a little bit of a shift. It's now the fourth Wednesday of every month. But if you ever do miss any of these classes and you want to go back and rewatch them, or maybe you'd like to share the information with a friend, we have all of these classes on our Facebook and on our YouTube page available for you to go watch at any moment for free. So those links are there. Definitely use those as a resource, and go back and check on some classes that you might not have had the chance to. If you're looking for more of an in-person event, we want to invite you out to our self-directed IRA social. So in the past, we used to hold our $1 trillion investment mixer. If you've come out to that one, you know how great it is for networking. We get a lot of people at these events that really want to be active and do deals, provide their service in their community. So we host this event in each one of our offices on the first, second, and third Tuesday of every month. Starting with Houston, going into Austin, and then rounding out the cities with Dallas. Like I said, those are all free. If you don't want to come in person, that's fine as well. We do offer it as a hybrid class, so you can join online and get your questions answered too by chatting in that chat box. So some promotions that we are excited to announce for 2022 are Refer a Friend promotion. So if you know somebody that is looking to get started self-directing, maybe you're an investment sponsor and you know people that would like to use their self-directed IRA funds, you can now earn credits when you refer people to Quest. All they have to do is, say that they were referred by you, and then not only will they receive a $25 credit, you will as well. So it's a really great way to kind of share that opportunity of self-direction, but also get some free money at the same time. So our Major League Investing event is also coming up in each one of our cities, and this is going to be a really big end of quarter lunch and learn. So we hosted an event a couple years ago called March Madness, and it was all about how to do a slam dunk deal in a small account. So we've changed it up a little bit, and we are doing our Major League Investing event, and it's going to be about how to hit a home run deal. So we're still sticking with our sports theme, but we're going to make it fun. We're going to offer hot dogs, we've got some Cracker Jacks, and we're bringing in 4 different guest speakers to share their case studies and how they were able to hit a home run deal. And then our umpire, along with our audience, will be able to pick their MVP player to see who had the best deal. So that one's going to be really fun. We've kind of given it a theme to make it a little bit more exciting. So do be sure to come out to that one and get registered online if you'd like to join from your computer. This one is in person, so do be sure to register for each one of our cities. Sorry to take up a lot of your time here. I'm going to keep running through them real quickly. But we have some events coming up in San Antonio for those who may not be in the Houston, Dallas, or Austin areas. We will be hosting a general investing lunch and learn all about how to amplify your retirement savings with self-directed IRAs. This one is going to be on March 24th. It is going to be for about an hour and a half at the Norris Conference Center in San Antonio. So don't worry if if you're not in one of our major cities, be sure to get registered for that one. It is free, and that one is going to be in person. This is the last slide that I have for you, so I will end with a bang. But the third annual Quest Expo is returning. It's going to be in Houston this year. It's on September the 23rd through the 25th. So it's going to be a 3-day weekend full of education, national vendors, panels. We have probably going to be about 800 to 1,000 attendees there. In the past years, we've had upwards of 600 and 700 people, and we just expect it to grow this year. So you can scan this QR code, you can get your ticket while it is still in early bird pricing, but do be sure to get that because tickets sold out last year. VIPs were the first ones to go, so if you're looking for that enhanced experience, with a little bit of extra perks, be sure to get them while it is still in early bird pricing. If you want to get in contact with us, feel free to reach out on our website, send us an email, or give us a call. We are always available to answer questions or provide more education. And if you'd like to schedule your consultation by scanning this QR code, even easier, it takes you right to our Calendly where you can jot down that 15-minute slot and go ahead and get it on the calendar. So without further ado, I will go ahead and remove my slides and bring up Fuquan, who is going to share with us some of the biggest regrets of a passive investor. So without further ado, I'm going to bring him up and let him share a little bit about who he is and what he's going to talk about today.
Hello, hello. Can you hear me?
We sure can. You're good to go.
Awesome. We're live. This reminds me of the old show you guys might not know when Ralph would go or Ed would go hamana 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 hamana. For some of the older audience, they may know the honeymooners. I'm nervous. No, I'm just kidding. So I wanted to thank you guys for having me on the platform. And I can't wait until the next Quest Expo. I know last year was virtual and it was definitely missed. It's definitely one of my favorite events to attend, and I will be in the house. So I already submitted my registration. Happy to bring the team out to enjoy this event. So my name is Fuquan Bilal. I'm the CEO and fund manager of NNG Capital Fund, and we invest in alternative assets. I've been investing in real estate now for 23 years. I can't believe it. I want to talk to you guys about some of the regrets that I have and some of the regrets I know a lot of passive investors have. So passive income streams can help you build. See, I told you I'm nervous. Passive income streams can help you build a sustainable financial plan that supports you in your retirement and beyond. Real estate investments are a great choice for generating that passive income that can be tailored to almost anyone's situation. Here are the 3 biggest regrets that I've heard. Not living in the present, not being bolder, and delaying investing till income is higher. So what do we mean by that? So of course, you want to start with risk tolerance and back into a return. So you're not taking excessive risks. A good buddy of mine, Mike Zlotnick, we call him the Big Russian. He may have been on this show before. He talks about 4 investment quadrants. And basically, how you mitigate risk is understanding these quadrants. So the first quadrant is cash flow focused, good downside protection, low to moderate risk, good initial cash flows. Could be first mortgages, leverage equity deals, something of that sort. Then the second quadrant will be growth focused, good downside protection, low to moderate risk, no limited initial cash flow. This can be value add projects, multifamily, first lien, non-performing. If you guys are investing in your IRA, buying those types of assets. The third quadrant is speculative grade, risk is high. Limited downside protection, strong initial cash flow. It could be second mortgages. I'm a big second mortgage guy. It could be performing, non-performing second mortgages, leverage equity deals. So for example, if you have a first mortgage position that you're lending someone on, the person who is lending in second, that will kind of fall into that quadrant. And then we have the fourth, which is growth focus, also limited downside protection, no limited initial cash flow, development, redevelopment, land. So which path do you go down, right? You have the fear of making a mistake when you want to invest your money, fear of investing in something and then it blows up. finding something better right around the corner, right? Keeping your dollars on the sideline while looking for that perfect investment. I can't recall the number of people who told me they just transferred money to their account, the their account, the IRA account, and they haven't done anything, right? Are you that person sitting on the sideline? I got news for you. Today's price is not yesterday's price. I'll say it again. Today's price is not yesterday's price. So you really don't want to have that the cost of chasing yield. That's opportunity cost. And I know you guys may know that, but we all fall into this. I'm guilty of it also. I have so many connections with a lot of trusted advisors and other funds or syndication. They send me all this marketing material, and I'm like, wow, that one looks good, but I'm going to do the due diligence on it, and maybe I'll look, something else might come through that's a little bit more better, and we may get into this habit of chasing yield or terms or everything else, and that money just sit on the sideline, and we spend months really chasing a deal, and nothing happens. I'll tell you a quick story. I actually started investing in second mortgages around about 2012, 2013. I formed my company, NNG. And we started off as a trade desk. We would buy paper. We would sell off the high quality, most equity deals. And basically, we would recapitalize on our spin and work out the rest. And I became very good at working out the hairy deals. As the market changed, that market was booming for the first 3 years. Things started to shift, regulation and certain laws had changed, compliance got tighter. More and more people were getting involved because people were getting educated. But what I saw was investors sitting on the sideline waiting for yesterday's price, right? To this day, I'm sure some of you probably will see this PowerPoint presentation. Some of them are still waiting for the 10 cents and 12 cents on the dollar deals. They're gone. We're now trading at 25, 50 cents or 60 cents, whatever it is, whether you're in first or seconds. Yesterday's price is not today's price. So always remember that. You don't want to have, the opportunity cost. You had the opportunity to make a return, but instead we all hold out for something better. That's one of the biggest regrets. So, how to invest with downside protection. Invest in quadrants 1 and 2. The risk is moderate to low. Usually you'll see average ROI 10 to 15%, low reserves, risk adjusted on average is between 9 and maybe 12%, somewhere around there. I'm going to keep that in mind. Invest with conservative focused managers and sponsors, people like and trust. This is the big one. You don't really regret some people make is investing in the deal instead of the person, right? This is a relationship business, and you have to keep that in mind, right? People who you do business with should be people like and trust. Yes, you met somebody at a conference or one of these calls or one of these sessions. Please do your due diligence, find references, get to know, like, and trust that person, right? Every time I speak with an investor on the phone, we go through the process, they ask about the deal, and then they go, hey, did I forget to ask you anything else you might want to tell me? And I say, yeah, you never asked about me. I like chocolate ice cream. I like vanilla ice cream. Just kidding. But you have to ask those questions, those personal questions, to get to know the person that you actually essentially invested in the person. And that person is who's driving the car, right? Who's managing the vehicle that you invested in. So get to know, like, and trust people, and invest with conservative focused managers and sponsors. Invest in diversified funds and build an overall diversified portfolio. So whether you're a passive investor and you're investing in syndications, whether it's multifamily, you're investing in funds, or you're investing in, ground up projects where you're more passive and you're not pretty much out there swinging a hammer, you kind of want to have those type of investments diversify with other investments within your portfolio. And I'm speaking strictly of alternative assets. I don't know anything about gold, oil, Bitcoin. I don't get into all that. I've been only doing real estate for about 23 years. So that's where my main focus is at. So having a diversified portfolio. So for me, what does that look like? On my personal side, I invest in syndications for growth, right? Growth opportunities, whether it's a multifamily deal, I will invest in something to have a pref plus equity participation for later on growth. I invest in short-term deals also. investments that have a short liquidity term. Me and my two sons, we actually take our IRA accounts and we invest in second mortgages for construction draws. So, for example, there are a few investors local to us that I know, like and trust, that have the 15% closing costs or 20% closing costs, the reserves, but they don't have the first phase renovation that's needed in order for the lender to fund them. So we will fund, the first $30,000 of these construction investors, real estate investor deals, to get them to their first phase, and that's short term. That's something I know our money could be in and out within 60 days, and we try to piggyback those loans on other deals, so we're not having that opportunity cost with our money sitting on the sideline. So if you are investing in something short term, try to line it up with things that you can hop in from deal to deal, and you want to watch your yield while you're doing that, because if it sits on the sideline too long, you're not actually making that yield that you wanted to make. So and you can't really do all this by yourself, right? You need a team. No one who achieves success do so without the help of others. It's so important that we keep that in mind, because even though we're talking about passive investing, you're still actively managing your investment. So you need a team to help you do that, whether it's virtual assistants or other key people that you have that can help you do that. One of the reasons that I wanted to do this presentation, because I speak to so many investors on a daily basis, and I like to get to know them on a personal level. I know what their goals are, if they have a freedom number, an ultimate number they want to get to passively, which they can kind of take their hands off the wheel and relax a little bit from working. And one of the things that they always come across is the opportunity cost. That's one of the biggest ones. Sitting on the sideline, waiting for that perfect deal, waiting for that perfect yield. So my question to you is, would you rather chase something if you made last year an average blended return of 12%, but there's nothing available now but something that's 8% or 6%? Do you leave that money sitting on the sideline until that 12% deal come up? Or do you invest in something short term, maybe a 90-day call option or a 60-day call option, where you can get that money earning interest that you can pull out to then go into that deal where you where the sponsor is ready to start taking in investments to get the higher yield, because that's the sponsor like and trust. So just keep that in mind, because opportunity cost is the biggest one. No good deals out there. That's what everyone says, right? Today's price is not yesterday's price. I could keep repeating that over and over again. Actually, I'm gonna do a quote with the picture of me saying that, because that is the biggest regret that I hear from most investors. And really, I just wanted to come on and share with you guys. And I'm almost done, but you can start posting questions if you have in the chat. But start taking action. Find out who you can partner with, who else is passive in your circle that you can partner with or do deals with, so you can keep the money churning. And make sure you do your due diligence on these deals, right? So the right person doing the right thing for the right reason with the right people for the right amount of time is what you want to try to get to. And watch out for those fraudsters, the dubious schemes that are out there. A lot of times, more than often, unfortunately, people get trapped in chasing the high yields, but the sponsor is, not the right sponsor to be dealing with, or the right person who's managing the investment. So you really want to see, the things that you're investing in. What's the track record? Have they been through market cycles? Are they market cycle tested, as I always say? What do they do when things go bad? Are they communicating well, right? Are they communicating with you well? Is, when you're paying they're paying their distributions on time, but what does that communication look like with those monthly or quarterly or annually distributions, right? Are they doing some type of quarterly reviews where they're updating you on your investment, even if it's just a pref? Like, certain things you want to look for so you don't regret, investing passively. K1s, the K1s come on time. Are you pulling your hair out because the last 2 years you've been in this investment, you had to postpone, file extensions? So really try to get to know the sponsor or the operator, and that is the person that you invest in. So those are the three biggest regrets that I hear the most when I speak with investors for about passive investing. There's other several personal ones about not spending time with family. I mean, that's why we all do this, is so we can have that passive income to have the freedom to do more with the family and create those memorable moments, which, really is important, especially to me, making sure that is families always first. So don't get lured into dubious schemes, which is going to put you further behind. Alternative assets to me is really the best thing since sliced bread. But yeah, three regrets of a passive investor. So any questions in the chat? I'd love to take some questions from you guys. My contact information is fbilal at NNG Capital Fund. You can go to our website and find more information there about the alternative investments that we invest in. So 3 regrets of a passive investor. Any questions?
All righty. So thank you so much for that. And we do actually have some questions. I love that you left us enough time to actually be really interactive and get all these questions answered. So I'm going to just start with Brandon. He says he's always looking for new partners. Now, I'm going to elaborate a little bit on this. What are maybe some due diligence practices that you would take when maybe vetting a new partner or someone that you would like to do business with?
Oh, awesome. Yeah, that's a great question. Yeah, so the first thing, as I mentioned before, is really doing due diligence on that partner, right? So what are your core values, right? Do they align with your core values? One of the ways to find that out, I always ask them, the three most influential people in their life, and then just give me one word to describe that person. And if those key words are in alignment with my core values, or some of the stuff in the conversation they talking about is in alignment with my core values, then we have a fit. That's the first thing, because it's not really, you're going to make money, but you want to make sure somebody have the same purpose, right? What is their purpose statement? Then once that's in alignment, then you look at the track record, right? What track record did this person have? Whether you're doing a fix and flip with this person and you're an active investor and you're trying to, merge together to cut costs with staff and supplies or just work together. Those are the things that need to go in place. Do the person work the same as you work? If you're being active, what is your expectation from that partner? Of course, all of that will go on the operating agreement. Who's going to do what? First, you guys go to the term sheet, then that goes over to the operating agreement. Who's going to do what? And then you have, weekly meetings. We have level 10s to kind of assess where we are with our rocks and deliverables to kind of make sure you guys are on the same page. But, and then it's really, background check the person if you have to make sure that, the person didn't file bankruptcy. They don't owe anybody any money. They're not bringing any challenges over to you. They don't have any prior or active lawsuits. That's a checklist of things that you can go to do due diligence. Referrals from other investors that invested with them, and just call them randomly. And if they've done some trusted investing, that's information you can do due diligence on. You can go to the county records online, pull that note and mortgage that this referral that they gave you said they lent the money, and you can see a track record of that this person actually lent money is recorded on this property, and you can do your due diligence that way. So when you speak to that investor, did they pay you on time? How was the communication? Everything go well? You can kind of do your due diligence. So there's several ways. I'm pretty sure that it can be a long list of due diligence checklists that you can do when you're trying to partner with people. But it's in this day and age, everything is social media. Someone's looking good online and all the box check online. But then when you meet that person and start doing business, it's completely different. So you got to really get in the right circles. And that's another thing, shameless plug for the Quest event. When you guys come to this event, you're collaborating with other investors. And that's when you get to ask questions about the vendors, about other investments, or maybe someone who you may be interested in investing. You can do due diligence right in the room. Maybe there's someone there that invested with that person, and you can see what their experience is. Hope that answered that question.
I love that you mentioned that, especially, just asking other people that are in your network. Like nothing spreads faster than a bad deal, right? Or when someone doesn't do what they're supposed to do. So I think that's great advice there. Now I do apologize. I don't know how to pronounce the name here, but one of our attendees asks, do private contracts regulate the operations of the deal?
Do private contracts regulate the opportunity? So I'm not an attorney. I'm not going to give legal and accounting advice. So what I usually do when I get into a deal, if it's a partnership you're speaking of, it all starts off with a term sheet for me. What does the agreement look like? What are the responsibilities of the person? Who's going to put in what capital? What's the expectations? Then the attorney gets it, and it goes into an operating agreement. So as far as if you're doing like a specific deal and you have a contract agreement related to that deal, then you definitely want to have your attorney kind of go through that and see what happens if you have a bad apple. If the person don't stand up to do what they're supposed to do, what can you do? I know as a lender on some deals, what I do is, for example, the example I gave you of that short-term construction deal, I will foreclose subject to the first if the person don't pay me. So, there's certain things that go into place. I have them sign in New Jersey. The laws are different everywhere, but I can collect the rents while we're going through the foreclosure process. There's certain documents and paperwork I get them to sign so I can immediately take control if they default. And if I have to, I'll foreclose subject to the first, finish the renovation myself, and then sell the property because I have that skill set and it's local to me. But you kind of want to put parameters in place when you make that contract that if you have to take over the deal, that you can manage it, or you have the resources to manage that deal, within your circle. Hope I answered that.
Yeah, that's huge. Yeah, we say the exact same thing. One of our attendees asks, would you please be able to explain downside protection?
Yeah, so downside protection, basically, you want to have, I think I have the slide here also. Let me bring up the slide here.
Okay.
So I'll show you as well. Yep. So downside protection is, I think this where you have a investment that you're putting in. What else is in there that's protecting you? So it's limited downside protection. It's, for example, let's look at quadrant 3, right? Quadrant 3, it says speculative, risk, high yield, cash flow focus. So in this, I gave second liens. So usually there's a first lien in place. The second lien will be a great quadrant 3 because the downside protection is limited because of the first mortgage that's in place. So it's still a good investment, but it's limited downside protection. So how do you increase your downside protection? You invest in quadrant 1, quadrant 2, where there's limited. I mean, there's not that much. It's good downside protection because you're first in place. So being a private lender on a deal in the first position, it kind of take away from not having good downside protection, if that makes sense. A tax lien is downside protection because it's first before the mortgage, right? If you can foreclose and wipe the mortgage out, a first mortgage trust deed investor has great downside protection. Anything that you have first position in, you kind of offset that downside protection. Anything that you're beyond a first, like a second mortgage or other type of investment where it's like land development, there's no house there, it's the downside protection is limited in those type of things. So I hope that makes sense.
Perfect. Thank you. Am I good to take the screen down?
Sure.
Okay, good deal. Okay, so we do have another question here from Byron. He says, does NNG Capital Fund lend on multifamily properties?
We don't lend on multifamily properties. We buy multifamily properties. We don't lend at all. We raise capital to buy alternative assets. Our model is a hybrid model where we buy fix and flips here in New Jersey, where I've been investing the last 23 years. And we have a multifamily acquisition side where we buy rentals in the southeastern area of the U.S. And that's our generate cash flow process. So we do rentals and fix and flips. Our prior fund that we have it's actually closed because it's fully subscribed. That fund purchased notes, rentals, and fix and flips all in that same vehicle. So that is a good mixture of being diversified. I showed a slide of being diversified and having some, downside protection. The fix and flips, we buy those that keep increased liquidity. The rentals is our hedge against inflation. And the note business is I think that's the best thing since sliced bread.
I love it. I love the passive, part of it. It's great for I use my Roth IRA to be a private lender, and it's just
Downside protection with that is lending in first position.
Mm-hmm.
If basically you have to take the property back, it's low to moderate risk.
Mm-hmm. Now I'm gonna post this and make sure it's correct. If somebody wants to get in contact with you, is it want to make sure I heard you correctly? It's fbilal@nngcapitalfund.com.
That's it. But you can catch me on one of the many social media platforms. I'm on TikTok.
Okay, you might have to show us a thing or two. We're looking to get in that space, but it is a whole
You guys
different.
can get me on Facebook, YouTube. I have a bunch of videos on YouTube you can check out of some of the renovations we do here in New Jersey. You can pretty much Google my name and it's not hard. I had someone call me yesterday off the blue and and try to answer every call. And I was like, how did you get my number? She was like, you're on the internet. I was like, okay, my cell number. Awesome. Great.
So actually, while I was putting your contact information up, we did get another question. And since we've got some time, I'm just going to keep going through them if you don't
Sure. Let's
mind.
go. I love questions. And one thing I usually try to keep a 25-minute presentation and have the rest for questions because most people
Yeah.
will run for an hour, then there's no time for questions. So I definitely would appreciate any question that you guys have.
Yeah, we love to make it interactive. These classes are for you guys. So if you'd like to get something answered, now is the time. Byron also asks, how can somebody like myself raise capital for multifamily properties? Any advice there?
Yeah, so experience is everything. If you definitely what I would say is be a investor in someone else deal first. If you don't really have that experience, be an investor in someone else deal first. Put capital up in a limited partnership and see how that works. See how you get your return. See how the function is. See what the sponsor does when they present the deal. What type of due diligence they doing. What market are they in? And really, once you go from there, you have to build a team. So it takes time. And multifamily investing is a team sport. You'll hear that all the time. It's just more than one person. One person can handle only one part of it. So you have some people who's good at due diligence, some people who's good at networking with the brokers, some people who's good at financing. So even if you have good credit or you have maybe anything above 5 units or more that you financed before and you have experience that way, you can get in on the deal that way as well. There's so many different ways. But raising capital for multifamily definitely would have to be something that you already had experience in, because again, you want investors to invest into you, the operator who have the experience on managing that type of asset class. And it's completely different from a 4 unit or 3 unit rental. Is completely different, right? I learned that through my experience, that every investment is different. You want to go over the hill first and get the arrows in your back before you start raising capital for it, because you don't want to take capital and experiment with it. So my answer to your question would be get the experience first before you start raising capital in those type of deals. Typically, the way it works is the lender will give you anywhere from 65 to 75%, depending on the type of lender. You can get, I'm doing a deal now where I'm getting 80% financing from a lender. But it has to make sense with the model, the rate and everything, the term, whatever, how many points they charge them, whether it's points going in, going out, whatever it is. But they'll give you a certain percent, usually somewhere around 65, 70%, and then you will raise the equity of the 30% plus your closing costs, plus first phase if there's any CapEx expenditures. So I hope I answered that question. And those deals are usually long term, 5 to 7 years, where it may not be any cash flow or anything on the first year during that value add process. But it's a good business. I mean, our purpose statement is we aim to provide financial solutions and quality housing to distressed environments. So what gave me my feeling of importance is going into these communities, revitalizing, putting the properties back on the tax roll. We did a lot of that footwork in New Jersey over the last 23 years. Now we position ourselves into the multifamily arena to kind of do that instead of the 2 or 3 families, 100 units, 60 units, doing that, having a community mind and its financial viability and providing a win-win solution and solving an affordable home crisis. So if you are looking to get to multifamily, I think it's a great idea, but get that experience before you start raising capital. That was a long-winded answer, but I did it.
No, it's good. It's good. So this is actually a really good question, kind of a two-parter here. So how do you ask sponsors to show proof that they have skin in the game, especially since now there are some that are just capital raisers, not just sponsors?
Yeah, that's a great question. So really, skin in the game, most sponsors would be involved in the GP side, whether they put money up for due diligence, for the soft costs. Usually some sponsors would be in on a deal with you. they will have, 100 grand or whatever, 50 grand, whatever the minimum is, invested as well. That's really what you want to look at. So that's what I was saying, to get to know, like, and trust a person and do the due diligence. So you won't have that regret of investing in something because the yield looked good, because it was an 8 pref, and with you can make 20% if, after 5 years after the value add. You want to be careful with that stuff and get the referrals from other investors that invested in other syndications with them. Did those syndications sunset yet? Meaning, are they over? Or are they still active? What was the final what was the projected return? What was the final return? And how was the communication in between? Those are the questions you want to ask those investors that they refer you. And then you'll figure it out once you do your due diligence, if this is the person you want to invest with. So you can't just go off of what's online. You really got to get out there into the community, shaking hands, kissing babies, as they say. I don't know if that's the right saying, but you get the point. You got to get out there, network, and really find out who are the people you can invest in. Don't be fooled by dubious schemes.
Yeah. All righty. Well, that was our last question. So going once, going twice.
Oh, man.
I'm also going to put your website up here. I grabbed that while you were talking there. But thank you so much for joining us. If we do have any last minute questions, send them in now. Thank you so much. Like I said,
I really appreciate it. I know it was short, but I want to be short, right to the point. I know it's people on a lunch break trying to get back to work.
Hey,
we'd
rather have more time than not enough time. So I think that's good. And we will have Fuquan back. I know we will have him back before the expo, I'm sure. But definitely get your tickets to the expo. He will be there. He'll have some more to share with us. But if that is all for today, I just want to thank all of our attendees and Fuquan for joining us. I hope you guys have a great rest of your Tuesday, and we will see you for our next webinar. Thank you so much.
Thank you. I appreciate it. Have a great day.